One Finance and Money Control present Personal Finance Unlocked. Download the One Finance app. Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.
Hey, hi everybody. My name is Kirtan Shah, and I'm the co-founder at Financial Planning Academy and managing director private wealth at Credence Family Office. I've been in the financial services space for the last 15 years now, and I'm happy to be on the show. Thank you so much. I think nobody would really get peaceful sleep at night if their finances are out of shape, right? I think the biggest stress that most of us typically have is to pay the next EMI or some major goals coming up. Now, if they are not planned for, you will definitely have a more stressful life versus being at peace. So I think finances, if are not very well directed or are not linked to a particular goal, you will definitely not be able to spend a lot of time and energy at work, socially, or even interpersonally. So I definitely think that if you have your finances in place and and your goals are taken care of, or at least they are aligned, then I think financial well-being is very easily interpreted as kind of being very close to mental health for sure, because if your finances are taken care of, your mental health is far more at peace. So definitely I believe that mental health is very 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 closely linked to your financial well-being for sure. And I think for me, investment planning is not about generating better returns. I think generating better returns can really be an outcome of the process. The process of investment planning actually includes understanding the investor's risk, understanding investors' goal, making sure that the asset allocation that is given to the investor is very close to the risk profile that she really has, making of a portfolio, monitoring it, rebalancing. And when you do all of these things, I think the outcome can be a better risk adjusted return. But let's say if a client's goal or an investor's goal is to generate better risk adjusted return, then definitely why not have the focus of returns. But I think in most cases it is about the investor wanting to generate better risk adjusted returns and not really a need. And why is this so important for the investor to really understand is because let's say if your goal requires you to only generate 8% returns, but if you are still trying to target 12-15% returns, you will end up making investment mistakes which you would really not want. So for me, investment planning is more about reaching your goal and less about generating better risk adjusted return. I think if you follow a process, better risk adjusted return will be an outcome. I think that's a very interesting question to bring up, because with this medium, I would really like to share this with a lot of us who are going to watch and hear us talk. I think, look, there are the answer to this question depends on three things, I would suggest. The first is how much knowledge do you really have of the market? Second is how much time do you really have to dedicate to investing? And third is how much corpus do you have? I think the decision between direct stocks, mutual funds, and PMS will largely depend on these three things. Let me help you understand what do I really mean. Let's say case one, if someone has all three, has the knowledge also, has the time also, and has the corpus also, then that individual might want to choose to invest directly in the stocks. Case two, when let's say somebody has the knowledge and has the corpus, right, but does not really have the time. Now this individual might want to do a mix of mutual funds and a PMS. But for everybody else, right, which is case three in my opinion, all of us should go for mutual funds. Why? Because I think it's an extremely well regulated product. It is extremely liquid, has multiple categories for you to choose from. uh, it has huge track record which has shown us how it can do a better risk adjusted return for a very long time. It's extremely cost effective, and you can actually start as low as 500 rupees. So even if you've got 10,000 or a 1 lakh rupee to really invest, you can actually diversify it across market cap, across styles of investing, across strategies, across geographies, across AMCs. So for everybody else who are not a part of the first and the second case that we spoke of, I think mutual fund is a far better investment option in that sense. So like say for example, mutual funds we spoke of, right? I helped you understand a lot of advantages of going through the mutual fund. In case of PMSs, what typically happens is that unlike a mutual fund where there is a pooled account where all the investments are put together and invested through a pool, in a PMS those investments are done in your own demat account. How is that as an advantage? When there is a larger behavioral change in investors, let's say for example, there is a COVID kind of a situation happening, and a lot of us want to redeem our funds. That actually affects that behavioral pattern actually affects a mutual fund kind of a structure and not a PMS. Is because in a PMS, investments are done in your demat, and somebody else's biases towards market going up and down cannot affect you unless you are looking at withdrawing your own money out of the PMS. So I think that's a small advantage of PMS, but I think PMS also has a lot of disadvantages in my opinion, because the buying and selling happens in your own demat account and hence you are taxed. Unlike in mutual funds, when you are taxed only when you redeem the units, right? Also, what typically happens is in a mutual fund space, SEBI extremely highly regulates of what will be called as a large cap, what will be called as a mid cap, what will be called as a small cap. But in a PMS, unfortunately, those bifurcations are not given, and hence an apple to apple comparison of a large cap PMS versus a large cap mutual fund is very different, because the PMS managers really have the flexibility and they are not binded by what is a large cap like it happens in the mutual fund space. And of course, another disadvantage of PMS, in my opinion, really is that the cost may be slightly higher if you're not a very sophisticated investor. Because today also there are so many different funds which still operate on a very high fee. They operate on a profit share, and in a very good year where the fund has really done well, you end up shelling out a very large profit share across to the fund manager. That's in my opinion the disadvantages of a PMS. Of course, a PMS can be very concentrated as a bet, and hence the risk adjusted return that you can generate if you end up selecting the right fund manager is also decent. But do keep in mind these disadvantages that I spoke of. I think with respect to direct equity investing, I think what we really have to understand is you really need the skill set to be able to do that. And it's not just about the knowledge, but it's also about the time that you would really have to be able to pick those right funds, right stocks, make sure that you are able to diversify it well, not over concentrate on a particular sector. I think only sophisticated investors who have the time, knowledge to be able to do that should go ahead and actually do direct equity. I hope that answers the question. I think I would like to keep building off a portfolio very simple. And I've seen this work for me for a long time. And I see no reason why this can't be replicated by anybody on the street. So I actually do three things to bring a portfolio together. First is make sure that you have market cap diversification. Second is you have strategy diversification. And third is you have global diversification. What do I mean? Let's say you've got 100 rupees to invest. Make sure that you put 33 rupees in large cap, 33 in mid cap, and 33 in small cap. When you do this, there is enough historical proof to help us understand how this particular portfolio has been able to very easily beat a Nifty 500 with a risk lower than that of Nifty 50. So I don't see a reason why this shouldn't be replicated. One. Second, we know that there are a lot of funds which follow different style of investing, and it's extremely impossible to be able to predict which style will really work in the next 2 or 3 years. And hence, spreading your investments across styles is also very important. So what I typically do is, along with spreading it across large, mid, and small, I also spread it across value style of investing, growth, and momentum. I think if you are able to imbibe this with a little bit of geographical touch to the portfolio, I think you have a very well diversified portfolio, in my opinion. Talking about gold, I think, look, in my opinion, gold is a very tactical bet. Of course, the next thing that I'm going to say is very period specific. But let's say if you look at the last 12 years, gold has delivered practically zero returns in dollars and 3.5% in rupee, and also because the rupee depreciated. So I think gold has its own areas or times where it really shines, but for a very long time it goes into goes into a loop where there are practically no returns. So let's say if you look at the period of COVID, it did really very well, but you will see another 3, 4, 5 years it is kind of stagnating, right? So for me, gold is actually a very tactical bet, where for people who understand macroeconomics and where gold really works well, right? You would want to take exposure to gold to make those negative correlation with equity work for you, right? But if you are only going to have 5 or 10% allocation to gold in your overall portfolio, does this even solve any purpose in the portfolio? And my answer to that is no. Is because you might have gold in your portfolio assuming that it has negative correlation to equity, and when markets go down, my gold will perform. But let's say if your equity proportion is 80%, and if 80% of your portfolio is falling, what is this 5%, 10% allocation to gold really going to solve as a purpose? So I am somebody who thinks that you should use gold more tactically than making it a long term allocation to your portfolio. I think for sophisticated investors, the answer is definitely a yes. But for conservative investors, I would suggest that you have multiple options. One good option being doing an FD in small finance banks, right, over other traditional products. I think conservative investors can definitely look at doing something like that. But for sophisticated investors, people who understand debt mutual fund is still definitely a very large investment opportunity, because for a sophisticated investor you understand that mutual fund will bring diversification in the portfolio. It also provides you liquidity, and also if you really understand how to invest in which category, it definitely makes a lot of sense from an opportunity cost standpoint also. Like say for example, currently at the time of recording this, we feel interest rates have topped out globally, and rates will typically start falling. So if you are a sophisticated investor and you understand this, you can position your portfolio to do long duration, and hence are able to generate significant alpha over what a fixed deposit or other traditional product may give you, along with liquidity. So definitely, I feel that if at all you are a sophisticated investor, there is a lot of meat to eat in the debt fixed income side of the portfolio. But if you are a conservative investor, you might want to stick to traditional products or slightly better products like doing a fixed deposit in a small finance bank. I'm really not a very huge fan. So I'm somebody who believes that you should have one house to stay for sure, but not really invest outside of that, is the way I look at it. Multiple reasons to say this. Real estate cycles are very large, right? They are 8, 10 years large. You look at 2010 to 2020, real estate, specifically in metros, didn't move anywhere. In fact, during the same cycle, people have actually lost money in real estate, right? Ticket is extremely huge in terms of size. You can't do a 5 lakh rupee investment in physical real estate, right? Liquidity is a big issue. You can't, like most other traded products, at a click of a button you can't get your money back. You will typically take 6, 8, 10 months, 12 months to really liquidate your asset, right? And rental yield specifically in residential real estate is pathetic, right? 2, 3%. Yeah, of course, if you do commercial, the rent yields are slightly higher, but residential real estate yields are not that great. So my view on real estate is that you should look at tier 2, tier 3 cities to really invest. And also you should have an understanding of the geographical advantages of the real estate tier 2, tier 3 that you're trying to invest in. if you don't have any of these things, stay away from real estate. Of course, you can use real estate investments or do real estate investments through probably REITs or fractional real estate. But I think largely, at least the way I look at it, it's a misconception, specifically in metros, that real estate generates mind-boggling returns. I think this theory has really come up because most of us don't really calculate IRR while we are trying to do real estate investing. So have one house. Outside of that, if you want to do commercial, is a better way to do it. REITs is a very good way to do it. Residential real estate, because of the yields being extremely small, I don't think makes a lot of sense for you to do investing. And largely, don't try and do these investing in metro. Tier 2, tier 3 are better places to do real estate investing. I think, look, asset allocation. There are multiple studies done around the globe where it is very categorically defined how 90% of the returns that you generate in the long term are really attributed to having the right asset allocation strategy in place. You look at the last 20 years and you will know that even if you've had a 70% equity and a 30% fixed income portfolio, your returns are very similar to a portfolio which has 100% equity, but your risk is much lower, right? That is as simple as understanding that why, reducing your risk and still having equivalent return to a 100% equity portfolio is a no brainer. So I think asset allocation, largely apart from reducing risk and generating better risk adjusted return, also brings in a lot of discipline because it reduces the volatility in your portfolio. I think irrespective of whoever you are, whether you are an aggressive investor or a conservative investor, you definitely need to follow follow an asset allocation strategy, because even if you are a risk taker, right? Having, let's say, 20% asset allocation to fixed income is extremely important, because every time we've seen that when markets fall, most aggressive investors, because they are aggressive and completely invested in the market, don't have additional monies to buy markets at lower levels. And hence, if they have 20% in fixed income, they will definitely have enough firepower to be able to buy markets when the markets fall. And similarly, even if you're the most conservative investor, right, you definitely would want to have some part of your assets in equity, let's say 20-30%, because that does not really change your risk profile significantly. But by adding that 20-25-30% to equity in your portfolio, you are able to then, on your 100% portfolio, even when 70-80% is fixed income, being able to beat inflation. So I think irrespective of your risk profile, I'm very clear that asset allocation is a must. The only difference or the only point that I would really want to add here when we talk about asset allocation is that most of us look at asset allocation from a risk return perspective. If I'm aggressive, I'll have more in equity. If I'm conservative, I'll have less in equity. But what most of us forget is that asset allocation also links or has a lot of link to your time to the goal. So let's say even if I'm the most aggressive investor, but if I only have 1 year to my goal, then I would still not want to put most of my money in equity, right? So please consider time as a very important data point while you are trying to do your asset allocation. I think, look, very honestly, short-term investing for me are more macro bets, right? Like, say, for example, currently while we are talking, we are expecting interest rates to top out and fall. So if interest rates are going to top out and fall, what it does is it does two things, right? It typically moves a lot of investors who are fixed income kind of investors to start looking at other opportunities to invest, and that's where a lot of money starts flowing into gold. And you would typically see when interest rate falls, your currency also depreciates, and because your currency depreciates and you are importer of gold, again it's a flip for gold. So let's say at this point in time, if I want to do tactical allocation, I will do tactical allocation to gold, and I will do tactical allocation to long duration funds, because I believe interest rates probably have topped out and they are going to start falling. So when I do macro based allocation, it is more short term, it is more tactical in nature, So I would like to believe that when you do short-term investing, you are trying to take advantage of the near-term movement in an asset class because of some macro environment change. But when you do long-term investing is largely more strategic in nature. You will not really get bogged down because the asset price is moving in the other direction that you anticipated. In fact, if you are a long-term investor and your investment is strategic in nature, if the asset falls, you will look at that as an opportunity to buy more, right? So I think that's how a short term and a long term is very different in terms of investment. And I think largely the difference is macro and strategic, right? So if you're taking macro calls, your investments are going to be short term. If you're taking more strategic bet, your investments are going to be long term. I think that's how they are different from each other. And macro and strategy in itself differentiates it from being a short term investment or a long term investment. I think it's extremely important, but I would really suggest that this is not a strategy for everybody, because if you really are not able to do it in the correct way, you might end up hurting your long term compounding uh, for which you uh, for which you anticipate to invest, right? But let's say two three strategies that you can really look at is first is capital gains harvesting. So every year up to 1 lakh of capital gains on long term is tax free, right? So let's say if you've invested a lakh of rupee and it's become 1,90,000, right? You can actually sell your investments, book that 90,000 rupees of capital gains as capital gains, and yet not pay tax on it. But you have to make sure that when you are selling, you immediately reinvest it, because you don't want to take reinvestment risk. It should not happen that to take advantage of this tax harvesting, you sold it but you've not reinvested and markets went up, right? So don't make that mistake. But of course, every year you can take advantage of up to 1 lakh rupees on capital gains by harvesting, by selling up to 1 lakh rupee of capital gain assets and reinvesting immediately. Also, what you can do is, and what I keep suggesting is taking advantage of losses or carry forwarding losses. What that means is, let's say if there has been a bad year, right, and your investments have seen losses, what you should ideally do is book those losses, right? Because you can carry that forward for a couple of years, right, and reinvest that money immediately. So let's say if you invested 5 lakh rupees and now it is just 2 lakh rupees, just hypothetical, book that 3 lakh rupee of loss, reinvest your money immediately, but you can carry forward this 3 lakh rupees for a longer period of time. So what happens is, when in the future you have a capital gains, you can set off and pay no tax, right? And also, ideally, what we should understand is deferring tax liability is a big advantage. So let's say if you're investing in an FD or a PMS, where taxes are paid every year, even when you've not come out of the asset, right? What that does is hampers your compounding effect, right? So let's say if there is an asset which pays 15% uh, as return, but if you are not booking those profits or you're not expected to pay tax on that, what typically happens is at the end of the 15th year you just pay once on that 15%. But let's say if you're doing an FD, right, every year, even when you've not booked it, you're still expected to pay that tax, and that hurts your compounding. So try and invest in assets which defer your tax liability and you're not expected to pay tax every year. I think these two, three things can really make a significant difference in the net tax adjusted return that you might be able to make over a long term. I think, look, for somebody who's starting new, you have to keep very basic things in mind. And if you are able to do those basic things, you are probably going to be able to do much better than most other money managers on the street. A couple of things that I would suggest you to keep in mind. First is make sure that you have a term insurance and a floater medical insurance in place before you start investing. Stick to mutual funds. Don't have more than 4 or 5 funds. Like I said, spread them across market cap and spread them across styles of investing. Invest as long as you can, because this is the only thing that you can do and is in your hand. to invest as much as you can and invest as long as you can. Do not try and time the market. And very importantly, use step up SIP to build wealth over a period of time. So every 3 or 5 year, when your income is significantly increased versus the last time, try and increase your SIP, so that with increase in income and increase in expense, you are able to create a larger wealth, which will help you maintain the same standard of living over a period of time once your active income stops. So keep investing simple. Do not try and complicate and invest in products that you don't understand. Just do this much, and like I said, you will be able to beat most money managers on the street. Oh, I think they are doing a great job. Is because the biggest requirement at this point in time in the industry is not transactionary advisory, but a holistic financial plan where you are looking at collecting the right data from the client. You are looking at their risk profile, their asset allocation, taking care of tax, taking care of investments, taking care of liability. I think that is what individuals today require, rather than transactional advisory, where you are just suggesting that an investor has 10 lakhs and where that has to be invested. So what people like One Finance today are doing is actually what is the need of the hour for the larger set of audience. And I think they are doing a great job, and I wish them all the best.
One Finance and Money Control present Personal Finance Unlocked. Download the One Finance app. Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.